All right, let's talk about trading indicators. You see them everywhere. They promise these simple, straightforward buy and sell signals. But, for so many new traders, they just lead to a whole lot of confusion and, yeah, unfortunately, a lot of losses. So, how do you actually use them the right way? Let's get into it.
Man, does this sound familiar? I bet it does. It's that gut-wrenching question that so many of us have asked ourselves at some point. You see a stock just blasting off, you get that feeling, you jump in, and then, poof, the floor drops out. Getting past that feeling, that experience, is really the first big step to becoming a smarter trader.
The root of this whole problem isn't about not having the right charts or the right tools. Nope, it's all in our heads. It's psychology. The mistake is getting sucked into a classic trap we call FOMO, the fear of missing out. It's that powerful urge that makes you chase a price that's already halfway to the moon. So here's the thing you have to understand. By the time a huge move up is so obvious that it's all anyone can talk about, the smart money, the people who got in early, they're probably already looking for the exits. You're showing up to the party just as the music is fading. You're buying late and you're buying high.
And this slide, this just lays it out so perfectly. Think about it. You would never, ever go buy a new TV without checking the price, right? You'd shop around, look for a good deal, a fair value. But in trading, so many beginners do the complete opposite. They see the price is already super expensive, and they buy it because it's expensive, just hoping it'll get even more expensive. It's a totally irrational move we'd never make in any other part of our life.
And that quote right there, that's everything. It boils down to the one thing you actually have power over as a trader. You can't control the market, you can't make it go up or down, but you have total, 100% control over the price you choose to enter at. Your number one job is to make sure you're getting in at a good price based on your own analysis, not because of some emotional rush.
Okay, so if chasing a hot stock is a bad idea, what's a trader supposed to do? Well, this is where a lot of people turn to technical indicators for help, hoping they'll flash a nice, clean signal. Let's dig into two of the most popular ones out there, the MACD and Bollinger Bands.
First up, let's talk about the MACD. Now, don't let the name scare you. At its heart, it's all about one thing: momentum. It just takes two different moving averages of a stock's price and compares them to see if the gas pedal is being pushed down or if things are starting to slow down.
So when you look at a MACD chart, you're really just looking at three main pieces. First, you've got the MACD line itself. That's the fast one. Then you have the signal line, which is basically a smoothed out, slower version of the first line. And finally, you have that histogram, those little bars, which is just a super simple visual of how far apart those two lines are. Okay, next up, we've got Bollinger Bands. The main purpose of these is to give you a sense of how volatile a stock is and to help you spot when a price might be stretched a little too far, getting overbought or oversold. Think of it like drawing a flexible channel around the price.
So, how's this channel made? Well, the line in the middle is just a simple 20-day average of the price. The top and bottom bands are then drawn based on how wild the price has been lately. Technically, they're based on standard deviations. But honestly, all you really need to know is this. When the price gets really volatile, the bands get wider. And when things are calm, they shrink up. Simple as that.
All right, so we get what these things are, kinda. But how in the world do you actually use them to make a decision? Like, where are the buy and sell signs everyone talks about? Let's break down the classic textbook signals.
So, for the MACD, the classic signal is the crossover. The idea is when the fast line, the MACD line, crosses above the slow signal line, that's a potential buy signal. It suggests that upward momentum is starting to kick in. And, as you'd guess, the opposite is true for a sell signal. The fast line crossing below the slow one suggests momentum is shifting to the downside.
Now with Bollinger Bands, the whole game is built on an idea called mean reversion. Sounds fancy, but it's a super simple concept. Price tends to eventually snap back to its average, like a rubber band. So, the strategy is to buy when the price hits that lower band, because it's seen as oversold, and sell when it hits the upper band, where it's seen as overbought.
Okay, so buy here, sell there. It sounds incredibly simple, right? Almost too easy. And if it really was that simple, hey, we'd all be rich. This is the moment where we have to hit the brakes and really think, because blindly following these blinking lights is a massive, massive trap.
Listen, if you only take one single thing away from this whole discussion, please let it be this quote right here. Indicators are good to know. They're helpful, but they should never be your main reason for a trade. They're a side dish, not the main course.
So why? Why aren't they the magic bullet? It all comes down to one huge fundamental weakness: market conditions. No single indicator works all the time, because the market isn't always doing the same thing.
And this slide just breaks it down perfectly. Bollinger Bands, which are all about price snapping back to the average, get absolutely destroyed in a strong trend. The price will just keep riding that upper band higher and higher, giving you sell signal after false sell signal. And on the flip side, the MACD, which needs a trend to work, will chop you to pieces in a sideways market, giving you endless fake buy and sell signals that go nowhere.
So what do? Do we just throw the indicators out completely? No, not at all. The solution is to put them in their proper place. And that place is at the very end of a smart, disciplined checklist that forces you to analyze the market the right way. Okay, here it is. This is the kind of framework the pros use. Step 1, you start with price itself. Do you see a clear candlestick pattern? Step 2, you look for context. Is that pattern happening at a really important price level, like a support or resistance zone? Step 3, you look for conviction. Is there a big spike in volume to back it up? And only then, after all three of those things line up, do you glance down at your indicator for a final check.
And this is the real secret to using indicators like a pro. See, the decision to take the trade was already made based on price, location, and volume. The indicator's job now is just to help you manage your conviction. If the MACD agrees with your setup, great. Maybe you take your full position size. If it disagrees, you don't necessarily cancel the trade. You just might consider taking a smaller position, respecting that conflicting signal.
So this completely reframes how we should think about these tools, right? It's about moving away from this idea that they predict the future and embracing a much healthier, more effective role for them in our trading.
The big takeaway here is to stop treating indicators like a crystal ball. They're not. They can't tell you the future because all they do is analyze stuff that's already happened. Their real power comes after you've done the hard work of analyzing the chart. They're just there to add one final layer of confirmation. Always remember, price is primary, indicators are secondary.
And that really brings us to the bottom line, the most important question of all. We've laid out the checklist, right? A framework for making smarter, more disciplined decisions. The knowledge is right here in front of you. But knowledge without action is pretty much worthless. So the real question isn't whether you understand this, it's whether you have the discipline to actually follow it every single time you put on a trade.